Hi traders, and welcome to today's webinar. First of all, I want to wish you a happy new 2019, and we start a new trading season. So basically, trading resumed today, and there will be a full year of trading, of course, with a small break around August, the end of August for summer holidays. But until then, we will be trading fully. So wish you happy new year, a lot of pips, and of course this is a price action trading school series that we are gonna have each week. So we continue with price action trading school. Today it's beginner's guide to technical analysis. So we will talk about technical analysis and technical trading. So before I start, let's do a quick sound check so you can confirm if you can hear me. And if everything is fine, we can start. So if everything is fine, we can start. So the sound should be okay. Okay, let's start with our webinar, Price Action Trading School, session 9. This is revised Price Action Trading School. New things have been considered, of course. Market change always changes, and we need to adapt to all changes that market will present us to, especially guys regarding risk and regarding trading. Losses are inevitable, but if you keep losses under control, of course you will always be able to have smaller drawdowns and bigger returns. Of course we will talk about it, but we need to focus on our session today. It's technical analysis. We go step by step. So each week, new trading lesson. And as time goes by, at the end, you will receive a free template. It will be a practical naked trading template at the end of price action trading school with all indicators that you should use for price action trading. So price action trading school offers 4 pillars. It offers 4 pillars. It's price action trading, risk management, market analysis, and of course, very, very important, trading psychology. It also, you need to know that technical analysis is the primary method of my communication with the market. So definitely, I prefer technical analysis, especially if I see the alignment with fundamental analysis. Robin is saying happy new year, everyone. Yeah, I wish you again a happy new year, and of course we are here to trade. We are here to make pips, of course, and be always on the right side of the market edge. So what is technical analysis? So the technical analysis, it's a methodology of forecasting price action direction through the study of historical price data. So old school technical analysis was based on candlesticks and chart patterns. Of course, with new technology, with new trading platforms, with MT4, MT5, and especially guys MT4, because MT4 is still widely used. I need to say that modern technical analysis uses a number of indicators such as RSI, Bollinger Band, Bollinger Bands, moving averages, and MACD. Of course, both approaches are good if you know how to read the charts, but definitely candlesticks should be also used in a synergy with technical indicators, especially because today there are a lot of algo trading. Algos are automated trading robots that are trading the price usually after the news. So combination of candlesticks and indicators will and should give you, of course, profitable results if you align it, of course, with proper money management. Definitely, technical analysis might stand in a contrast to fundamental analysis, because usually when technicals say price should go up, some news during the day can reverse the price. So during intraday trading, it will usually stand in opposite to fundamental analysis. But real fundamental analysis is not done as news trading. News trading is something different. So fundamental analysis should be used just as a guidance to have a full picture of possible future movements, like mid-term trading, or let's say long-term trading that equals to investment. So have in mind that if you trade and if you want to use technical analysis, if you trade on intraday charts, swing charts, like trading on 4-hour time frame that we are based on 1 hour and 4-hour time frame, definitely technical analysis should be your primary method of trading the price. So usually during the day, technical analysis will stand opposite to fundamental analysis, and but it's important to know that again, it's very widely used by day traders. So day traders who start to trade, those traders who actually trade on 1 hour time frame, a 4-hour time frame, 15-minute time frame, 5-minute time frame, they simply use technical evaluation of their methods and systems to place trades. Okay, so it will stand usually opposite to fundamental analysis, just for intraday and swing trading, and of course scalping. That's completely usually opposite. But very often it can happen that news during the day can align with your entries and give you an immediate spike of the price in desired direction. But anyway, technical analysis is superior to fundamental analysis in a lot of ways. A lot of traders probably will not say that I'm correct with it, but at least how I trade and at least with my results, technical analysis is superior to fundamental analysis. Of course, it doesn't mean blindly following the system, because every trader always needs to assess a signal from a system to see if the signal is correct and if the trade should be taken or not. So your job as a trader, no matter if you have a system or you're trading just naked charts, that is less probable, you always need to assess a signal from your chart as a trader and see if it's a valid, if there is any logic or not. Of course, trading with expert advisors is something different, but now we are talking about technical analysis, and technical analysis is always done before you actually take an entry in the market. Why? Because the study of technical analysis suggests the historical behavior of the price, because all information that you see is usually already reflected in the market's price. So you will analyze the price, market pairs, and chart patterns. Definitely, when there are some unexpected news, out of the blue announcements, it will mess up with your technical analysis. And especially if you're in a trade, it can actually lead your trade to actually hit a stop loss instead of profits. But good thing is that with technical analysis, you can spot a trend, because the price usually moves in trends. And the biggest advantage is that history repeats itself. Because of that, with technical analysis, you are able to backtest the behavior of the price in your now moment that will give you future result. That is why I always say past plus present give you the future outcome. So past is technical analysis, right? And historical buyers and sellers at certain price levels, plus present. Present is now moment. So you see what price is doing now. If you align past and present, usually you will have more than 50, 60, 65% of chance that the price will go your way. Of course, some unexpected things such as profit taking, some news can mess up with technical analysis, but technical analysis is not trading. Technical analysis is done prior to making an entry into the market. Now, the basic premise of the technical analysis is that market action discounts everything. So usually what you see, everything is priced in. So when you see that market is going up, you know that some things happen in the past that already reflect the behavior of the price. And if you see that today's data for some markets are positive, usually that data has already been reflected in the current price. So that is why it's important to watch trends, as price moves in trends. So there is bullish and bearish trend. Flat is not trend. We already talked about it. Flat market is sideways market. It's not trend. Trend is either up or down. Sideways movement is not trend. And any trend usually continues, then change. So that is why it's important for all traders to understand the principle of trend, retracement, and new bullish or bearish leg. Trend, retracement, entry. Trend, retracement, entry. It's every retracement or pullback is actually trend. It's a part of the trend. So that is why technical analysis is used by intraday and swing traders. So have in mind, guys, don't never forget it. Trend is also if the price is going up and it starts to move down. It's also a trend. As long as there is bullish zigzag or the price has been continuously rejected at certain levels, it's a trend. Reversals are something different. So do not forget that trend is your friend, and you should always follow the trend, because the trend is made by big markets, by big fish that usually move the price along with huge orders that are accumulated on the chart, and you will usually see the price going up, down, and flat. It means sideways when market is calm. Flat market will indicate that soon you should be ready to either buy or sell. It's called accumulation, and it's also part of technical analysis as a market phase. But for you guys, especially if you are new traders, have in mind that trend is your friend, and you should always try to trade trending markets unless, of course I'm saying unless, market proves you different. So there is a change of price and you want to trade counter trend. So try, guys, to always follow trends. It's very important. If you do not follow trends, then you usually will have a counter trend trade, and those counter trend trades will definitely lead to a lot of losses in the markets. Okay, so that is very important. Now, guys, the management of trades is something different, because when you have a market order or when you trade with the trend and market orders, you always need to follow the price precisely, as intraday trading is susceptible to sudden price changes due to, as I already explained, news releases or some unexpected out of the blue announcements in the market. Swing traders are not that susceptible to intraday movements, but they also should follow some important releases that can happen during the week. Now, the purpose of technical analysis is something that I will also cover. The main purpose of technical analysis is to determine the current direction of price action. Okay, it's very important, and estimate the time period of this direction. Short-term trend, long-term trend, beginning of the trend, maturity, and the end of trend. It's very important. It's extremely important, because if you see that the price has established a short-term or long-term trend or beginning of the trend, you need to know where to exit the market. Exiting the market is actually the hardest part, because sometimes you will see that the price goes your way, goes your profit, makes you profit, but then suddenly it changes and goes the opposite way. So the time period of the direction is also estimated by technical analysis. The range of price fluctuations is also estimated by different indicators that we will cover during price action trading course. And when you identify everything that is important, so the beginning of the trend, the end of trend, the range of price fluctuations, okay, then it's possible to say whether you should enter the market with a buy or a sell order. Definitely, whatever happens, the experience is one thing you cannot get for nothing. Okay, it's very important that you have screening time, and that technical analysis is something that cannot be learned over the course of several months. It takes a lot of screening, a lot of trial and error. And especially if you are just an analyst, let's say you're not a trader, but you will be traders, of course, because we are talking about trading the price, not just analyzing the price. Of course, the experience is something that is very, very, very important. So that is why I always advise new traders, trade and treat your demo account as if you were trading a live account, because it's extremely important for you guys. If you want to be successful in trading, you need to have a result on demo account. Okay, at least you need to treat it as a live account, then go to live account. Do not jump start, or do not enter the market without any demo trading. You will lose, guys. Believe me, this technical analysis is something that is hard to master. It requires a lot of dedication, but it's not impossible. It's very, very possible if you just pay attention to most important things, and then you actually dissolve these things into smaller important things, and you put it all together. But trend, the range, the current movement, and the past movement are the basis for technical analysis, because in Forex market, price repeats itself. Now, types of charts, guys. Line chart, there are 3 types of chart, but for technical analysis, I and majority of traders are using Japanese candlesticks. But before Japanese candlesticks, there were line chart, and well, for me, only for shorter time frames. It's only valid for shorter time frames. For me, it's definitely useless. I don't use line charts at all. Bar chart, it was mostly used before the Japanese candlesticks, but definitely, I need to tell you that Japanese candles are my favorite way, and a big majority of traders are using Japanese candlesticks. It's my definitely favorite tool for analyzing the price. Also, guys, there are trend models that we should mention, and the figures of technical analysis and indicators are something that always should be on your charts. So as I said, and we talked about Japanese candlesticks, okay, but also indicators, guys. For successful analysis, you should always have few indicators. You don't cluster your chart with a lot of indicators. Only few indicators, like some people use moving averages, MACD, RSI, Bollinger Bands. I personally prefer MACD, Bollinger Bands. Of course, trend lines that are charted manually, but other traders might use Awesome Oscillator, RSI. There are dozens, literally thousands of indicators. But in the core of all those indicators are actually those basic indicators, like moving averages, MACD, RSI, Bollinger Bands. Do not forget, the core of indicators are actually indicators that have already passed the test of time, and then you can just upgrade it. But for most traders, those basic indicators should be enough. Very important thing, guys, about the Forex market and currency futures market, especially, guys, when it comes to analysis and technical analysis. On over-the-counter Forex market, tick volume analysis assists you in sizing up the market on an intraday basis. And as I said here, information pertaining to open interest and volume is not available because transactions are carried OTC, over the counter, and not through exchanges. There is no central exchange in Forex market. Okay, there is no central exchange. For currency futures market, open interest and volume data on currency futures allow you to gauge market sentiment in the currency futures market, which also influences and is influenced by the spot Forex market. So we are talking about spot Forex market, and the very, very important thing and very important stuff, that is technical analysis, that you should always do prior to opening any trades. Open interest is a total number of contracts entered into but not yet offset by a transaction or delivery. In other words, these contracts are still outstanding or open. Have in mind, guys, that when we talk about trading a Forex market, especially, we are trading the OTC Forex, not futures market, okay, not currency futures. That is also influenced by spot Forex. Now, as I already told you, there are some conflicts between technical analysis and fundamental analysis. How to resolve those conflicts? Intraday analysis should always be made prior to any potential trade in the market. And you always need to analyze the price and the risk before entering the market. If your risk is 3%, having 5 losses in a row will lead to only 15% of your account lost. But if your risk is 10%, 5 losses in a row will give you minus 50%. That's important for you to understand. Losses are part of the job. Intraday analysis, however you're good in your analysis, as I said, algos, news trading, some out of the blue announcements can mess up with technical analysis. So get to know the pair which you will trade, and if you do the analysis before you enter the market, analyze the risk. What is your maximum risk? Always check your calendar first for any red news. Okay, unexpected events such as central bank interventions, Brexit, out of the blue announcements cannot be controlled or predicted. It's the risk that we all need to take. Always respect and follow your charts. Do not trade 30 minutes or 15 minutes prior to strong news, or if you're in a trade and you are in a profit, protect your profit. If you are not in profit, you have stop loss, so you need to wait. Unusual spike in the price, like big spike up or big spike down, is probably led by some news release or rumor, because the price tends to correct itself afterward. It's very important, guys. After it happens, there will be some slight corrections in the market. And when price corrects itself, then it's a time that you wait. Do not exit the trade. If you're in a trade after the price corrected, wait. It will be either profit or a loss. But if you already know how big your loss should be, you should not be afraid. If you are having uncontrolled losses, then is the time where you should be afraid. Also, use fundamental analysis as a guidance, okay? Because technical levels cannot be seen just by using fundamental analysis. Intraday, fundamental analysis might mislead technical traders by spiking the price. Always believe your charts. It's important, guys. Intraday, fundamental analysis, it's only good for small time frames, like if you want to trade the news. But if you want to trade during the day, next day, or a week, you need to believe your charts. Then that is when you only use technical analysis, because that news will reflect on the price. If something negative happened, then the trend will change from bullish to bearish. So there again will be a change of trend, and you will follow the trend, right? So believe your charts. It doesn't matter if you lose, there will be always time when you will make up the loss. Intraday and swing traders should avoid fundamental analysis trading. So intraday traders and swing traders only trade with your charts. News traders trade on lower time frames, but it's the section for itself. We will come to news trading. It's not important now. So smaller, I can say smaller objective fundamental analysis, like analyzing the news data after the news has been released, can be traded on smaller time frames, like a minute time frame or 5-minute time frame. But it's not true technical analysis, because true technical analysis on intraday or swing time frames, 1 hour, 4 hour, it means a daily analysis, a weekly analysis, is only done, guys, okay, on higher time frames. Preferred is 1 hour or 4 hour. Do not trade on bid rate days. Okay, it's important, guys. If you see a bid rate announcements, you never ever should trade on bid rate days, stress tests, Fed, or ECB conference. It's very, very important. Okay, very important. Now, the advantages and disadvantages of technical analysis. The advantages are multiple. We are going with a trend. We are using market momentum. Orders have already been made, so we are following big money. It gives us early entries because history repeats itself. That is the biggest advantage of trading Forex market, of analyzing the price. So the basics of my technical analysis is price repeats itself. Where if we had a lot of buyers in the past, usually very close or at the same spot, in now moment, we will also have buyers. Vice versa for sellers. If we saw historical sellers Now moment sellers should appear at very close levels where they historically appeared. And correlation, guys. Correlation between markets can be very positive. It can be also negative, because if you open a basket of trades like GBP dollar, GBP Australian dollar, GBP New Zealand dollar, and all of them have positive correlation, 3 trades can give you a lot of profits, because usually correlation follows major currency pairs. But it can also be a trap if you are on the wrong side of the market, that correlation can be negative. So disadvantages, technical analysis can be a bit subjective. That is why I said it's very important, guys, that you have experience in trading, in technical analysis. It's not newsproof. You are very prone to algo trading, so you can be in profits, and in a second, it can actually go your opposite, or the opposite side of your trade. Because if news or out of the blue announcements kick in, your trade, instead of profits, can go in loss. It's usually because of algos, automated algorithm trading. Intraday analysis is harder to make than a long-term analysis. Okay, you need to know that, because the price fluctuates a lot. Price fluctuations are a lot more dependent on intraday time frames than on higher time frames. And previously said, correlation can be your friend or your enemy. So that is why the risk is, if you are trading as a part of your technical analysis, risk should always be taken into account, predetermined risks. And some facts: technical analysis analyzes the past, but it does not predict the future just based on your technical indicators. You can be 70 to 80% maximum successful in your technical analysis. I always say 70 to 80%, because 20% or 30% is usually something unexpected. So it can analyze the past, it can give you the future outcome, but it will not predict like you have a crystal ball and you see everything. Most of the time, if you know what you're doing, you will be correct. But also 20-30% of the time, there is no way that you can be right 100% of the time. So 20-30% of the time, you will be wrong. Every chart pattern is unique. It's crucial for trading, guys, doing a complete technical analysis before you make a trade. Your system will help you out in that. But also, as a trader, think about the signals. Is this signal valid or not? If you think it's valid, as a trader, you take the signal. Probability versus gambling. It's a crucial part also of technical analysis. With technical analysis, you are stacking the odds into your favor, probabilities. But if you trade with a big risk, it's called gambling. So no matter how good you are, with gambling, ultimately you will lose. That is why you need to control the risk. If your probability to win is 70 to 80%, and you did it with 1% of risk, you still can lose account in a single trade if you take a trade with 50% of the risk. And even though if you're right, as I already said, 20-30% of the time, even if you're right, you will be wrong. You will kill all of your good trades because your risk was too high. So always, when you make a technical analysis, before you make an entry, do a risk assessment. How big should be your trade? Experienced traders can risk up to 5%. I always say between 0.5 and 2% should be your entry, especially if you're a new trader. Risk only a small part of your account. Trading is not analyzing. Analyzing is a technical analysis is prior to trading. After you do your assessment, your homework, technical analysis, then you trade. And trading includes the main component, it's the risk. Because guys, you will be trading the risk. You always trade the risk. No matter how good your system is, how good your technical analysis is, if your risk is wrong, if you're taking too big a risk, your account will go in a drawdown that will be very, very hard to manage. And also, guys, it's very important that you understand the timing. When you see that market is not doing anything, wait for it to start to move. If you trade on intraday time frames, your technical analysis should be done let's say 15 1 hour time frame, 15 minute or 1 hour time frame. My suggested time frame is 1 hour. Session times are also important. Trade major sessions only. We already talked about it. London, New York, and of course Tokyo session. Those are 3 major sessions. Look for major news. If there are some major news, wait for the news, then go in a trade. Or if you want to go in a trade prior to news, be sure that you protect your trade once you're in profit. Okay? And don't forget that there are dozens of different methods for analyzing the price. But the basics of technical analysis is historical versus now moment buyers and sellers, candlesticks, and of course the indicators that will stack the probabilities in your favor. If you have any questions, feel free to ask me. This webinar is recorded. It will be uploaded to YouTube channel. So you can leave your comment below. You can ask questions. I will be sure to reply. And if you guys are still not sure what technical analysis is, especially if you're a new trader, watch this webinar a couple of times until you get into your head that the importance of technical analysis is crucial, guys, for successful intraday and swing trading. I don't see any questions. So again, I wish you a happy new year, and I will talk to you soon, guys. Cheers. As always, trade safe.